call it that. I didn't call it that then, and it's taken off more recently in the last couple of years. What it is you look at returns and you look at various factors which could impact them. So here what I'm looking at is just a variety of companies which have been impacted by coronavirus, and as you will see, there are certain factors we could look at. The 1 week return, is that a good factor for forecasting the year-to-date total return of a company? And you can see that actually it's not that great. In other words, if it's done well over a particular week, is that a good way of forecasting? Or 1 month return, or 3 month return, or 6 month, or 1 year total return? Is that higher? That is it more likely to suggest that the year-to-date return is going to be high as well? So you can look at that and say, well, actually, it does for some, but not for others, so it's not a particularly good one. What about factors relating to valuation, such as price-earnings ratios? Okay, price-earnings growth ratios. What about enterprise value, another way of saying price, over sales? All right, as opposed to price to earnings, this is price to sales. Or enterprise value over EBITDA, another way of saying price to earnings. EBITDA, by the way, if you're technically minded, is earnings before interest, tax, depreciation and amortization, or price to book, dividend yield, and so on and so forth. Well, that's a slightly better forecaster of corporate value. The factor strength here, for instance, tells me that actually price to book and dividend yields, lower dividend yields, not higher, lower, has been a better forecaster of price movements of companies which have been affected by the virus. And I said, whoa, how do you break all this down? Well, yeah, it's multi-dimensional chess. It's like sort of trying to do a Rubik's Cube. And that's not all, because of course it's not just, well, what about estimates? Have they been any use? Not really. So estimates of certain stocks actually not been that great. What about the actual results? Have they been a good forecaster? Revenue growth, for instance. Now, those of you who know how I select stocks know I look at valuation, revenue growth, earnings growth, volatility. I look at a multitude of factors. And you will know that there's a lot of these that I tend to look at. For instance, sales growth, revenue growth. You know that I'm looking at these performance and volatility around performance and so on and so forth. Anyway, there's a whole bunch of factors that can go in, and we need to know, well, what's important, what isn't, what's working, what isn't, and when is it working, so the weightings can change. Anyway, my job through educating people through the Great Investments Program, the Great Investments Program that I created, is to educate them and teach them which factors, what's working, and what's performing, so that we can have not just the academic background, but actual useful outcomes. Right, we can learn from objective data which companies are performing well and are likely to continue to do so. No guarantees, there never are in the market, but at least we can learn what factors we might want to examine, what weighting to give them, and when to change that weighting. So what information is important and how important is it? Those are the only other two things you ever need to know when making any judgment in anything in life. What information is important, how important is it? Those are the two things you need to know. And we're just doing the same when we're picking up. So factor investing is actually, well, it's been there for a while. I've been using it before it was called that. A lot of money has gone into factor investing. You might hear that terminology. It works. The reason it works is because unlike traditional methods of growth funds or geographic ones, which are too limited, they're only looking at a very few factors, geography or a particular type of thing. This looks at everything, and you can imagine it's a lot better. It's like the unified theory of investing. Works a lot better than just how traditional long-only fund managers do it. So why don't traditional long-only fund managers look at all of these things? Well, they'd be out of business if they did. For a very simple reason. They're told by their bosses, create me a growth fund for the UK, a global value fund, a momentum fund. That way they can sell you more products. The more products they can sell, the more assets they can take in. And by the time you discover they're underperforming the market because they're only selecting from a narrow universe of equities, it's too late. 5 years have gone. They've taken 10% of your capital just in fees alone. Let alone, I do doubt the intellectual capacity of long-only fund managers as well. Hedge funds tend to use factor investing. Requires a bit more intellect. Sorry, it sounds a bit snooty, but nobody's really going to come to the defense of long-only fund managers now, are they? I want private investors to be educated, financially literate, financially educated, because every point of data suggests the more financially literate you are, the more likely you are to own investments, the more likely those investments are to perform better, and the more likely you are to create wealth and therefore be socially mobile. Socially mobile, okay? That's why investment education is so important to me, from the days I was writing my Financial Times columns and my books till today, and that's why I devote time to do these free videos. Right, so hopefully that's given you a good overview. Have a look at alpeshpatel.com for more. Thanks very much.